Federal Reserve. What is the Federal Reserve? Often called the Fed, the Federal Reserve is the central bank of the United States and is by and large the most powerful financial institution in the world. The Federal Reserve System holds the monetary authority of the United States, and its goal is to provide the country with a safe, flexible, and stable financial system. It's currently run by Jerome Powell, who serves as the chair. Throughout history, there have been about 16 chairs, who essentially run the bank like the CEO of a company would. But why the Federal Reserve? Established in 1913, the Federal Reserve Act was signed into law by President Woodrow Wilson. Pre-Federal Reserve, the U.S. was the only major world power without a central bank, the lack thereof being attributed as a core cause of the 1907 financial panic, and thus the Wilson administration's motivation in establishing it. The Federal Reserve, being the central bank, has broad power to act and ensure the financial stability of the U.S. and is the key regulator of banks that are part of the Federal Reserve System. Essentially, the Fed functions as a lender of last resort, ensuring that these banks never run out of money. The Fed carries out four main duties: influencing and conducting national monetary and credit policy, supervising banking institutions to ensure legal and secure actions, ensuring the U.S. economy is stable and not at systemic risk of collapse, and finally providing financial services through payment and money printing. Being the central bank, the Fed simply oversees and regulates the money supply of the entire U.S. economy and sets interest rates or lending rates between banks. The Fed can ease or tighten money supply and available credit as dials to keep the economy functioning properly. But how the Federal Reserve does its job of ensuring a stable and secure economy is another question entirely. The Federal Reserve has many dials to turn to enact monetary policy. It can choose to print money, for one. The Federal Reserve issues all paper money in the U.S., known as Federal Reserve notes, and by printing more or less of it, it essentially controls the money supply in the country. The Fed can also set interest rates. These are the rates of what interest is charged on lending, and these can primarily control what happens to inflation. The Fed targets an inflation rate of about 1 to 2% each year, which is considered healthy by economists. Since the Fed is a private bank, it does have to make money of sorts. It does this by charging interest on government securities it has acquired, along with returns on foreign currency investments, loans to banks, and fees for services such as clearing and fund transfers. If the Fed turns a profit, it turns over any profit made each year after expenses to the U.S. Treasury. So, if you clicked on this video wondering what the ever-loving Federal Reserve is, it's the U.S.'s central bank that controls monetary policy in the U.S., sets interest rates, prints money, and is otherwise tasked with making decisions that keep the U.S. economy growing and stable.